All right, welcome everyone to SSP live stream. I'm Jaden Sterling. How are you? Today is, wow, can you believe it? The end of April, the 24th of April. Lots to cover today. Let's dive in. More talks of rounds, layoffs from companies. We've got Disney begins their second round of layoffs as company aims to cut 7,000 jobs by summer. I thought this was very odd because, typically summer is their busiest time, right? Families go on holidays, they take their kids. So we're seeing this interesting phenomena happen where companies, brick and mortar, these companies are continuing to cut their workforce, 7,000 jobs by summer. There's another big story in the news today. Bed Bath & Beyond bankruptcy poised to boost online retailers. So we are seeing a clear departure from these big brick and mortar stores. Remember when Sports Authority, if you're in the US, remember when Sports Authority went bankrupt, closed their doors. Sears closed their doors. And so they're suggesting that these online retailers are going to pick up the slack for this business because as more and more brick and mortar stores close, they're suggesting that online retailers will get the lion's share of the money. At the end of this live stream, I'm going to share with you a company that I think is certainly worthy of your investment dollars. So this is something to look out for as an investor in terms of staying away from these large, we've thought in the past that if a company was big, if they were diversified in their business model and or had a lot of retail stores, a big presence in the marketplace, that they might be able to weather a downturn. But now we're just seeing these companies close their doors. So, I've been saying for a while, stay away from these retail, consumer retail companies. Bed Bath & Beyond would fit that description. So we've got we would expect revenue. So this is an analyst. We would expect revenue from the Bed Bath & Beyond wind down to be relatively widely dispersed to the largest competitors in the market like Walmart, Amazon, Target, Wayfair, Williams, Sonoma. So this, take a look at this article, do some research if you're interested in investing in this space. I mean, I am going to offer a suggestion for this space that I think based on everything that's happening, I think could do very, very well. This story hit Barron's today. Just a lot of in the press with these companies not delivering, falling short, filing for bankruptcy. This is going to disrupt the industry, I think. I think that, given the uncertainty in the banks right now, and now we've got these big retailers closing their doors, there's going to be a big shift away from these retailers and more into these online. I mean, look, we know Amazon's been growing leaps and bounds all these years and decades, and I think it's going to continue as well. Just wanted to point out, hey, Chris Johnson, if you're watching this, good call on this stock, Hyperchange Networks. You found it before this big spike here. Let me see. I think you marked the price right here. 21 days ago, Chris says huge volume on big news from Hypercharge this morning. More to come. EV charging stations up 63% this morning. The stock price as of 10 a.m. April 3rd was 73 cents. it's sitting at 250 right now. So wow, what a huge move in a very short period of time. Way to go, Chris. 3 weeks. That is a move. Just I can't get what 300%, something like that, maybe more. Huge move. So congratulations on that. Want to point out this article here. I don't know if you saw this, but this is, to me, one of the most bass-ackwards articles I have ever seen, but it's true. That's what's so scary about this. Biden raises costs for homeowners with good credit to help risky borrowers. Now, typically in the past, if a borrower didn't have good credit, then they either would not be approved for a home loan, or they would be considered a risk. So therefore, their interest rate would be higher. That's what typically has happened. But now this is going to happen in a way that home buyers with good credit scores will soon be facing higher mortgage fees as the Biden administration seeks to close the racial homeownership gap and get more first-time and low-income buyers through the door. I mean, first of all, the whole premise behind this, frankly, I think is absurd because interest rates are so high that low and first-time income buyers, low-income buyers and first-time buyers are priced out of the market anyway with high-value property valuations. This is simply a cash grab from people who have good credit scores and who have a good payment history. And I don't believe it's only going to be $60 a month. I mean, are you all seeing this, right? Like a new federal rule. Now, this isn't called a law yet. It's called a rule. But the big players in this space, Fannie Mae, Freddie Mac, are buying into this rule. And anyone who's going to see either someone with good credit who's going to be buying a home, you're going to be paying higher fees, you're going to have a higher interest rate than someone who has low credit or no credit. Or bad credit, right? Just bad credit across the board. So this seems to me just absolutely absurd and ridiculous. But hey, it's happening. It's going to start May 1st. May 1st. It's just unbelievable. So, you know, y'all, with everything going on, these retail closures, the banks having challenges on their balance sheet, that's going to play out for some time to come. We don't really know the direction that will happen for the banks with this fallout. That's an ongoing situation that we're going to have to watch closely. But my pick for this time right now is Home Depot. Home Depot, I mean, if you think about it, all these homes across the U.S., North America, through the flooding, through the fires, all these disaster situations are causing people to have to rebuild. And I think this stock sitting here at $300 a share, it's above all of its short-term and intermediate-term averages. The SMA 200 is just just a slightly over $1.40 above this. So that's right at the right spot. Sweet spot on the MFI, look at that, 55. I don't think you can go wrong. It's a dividend-paying stock. You're going to be paid a yield of 2.8% while you wait for the stock to go up. We have a 4-star ranking, and it's a below average risk company, industry best on our most watched in our community. I would be picking up shares here right now. Once it crosses over the 200 moving day average, we will end up with we'll have a buy rating on it. So just pick up shares while you can. Almost 72% of insiders are buying the stock. Just looks good to me. Very short percentage of shares outstanding. So that's very favorable for this company as well. That's my pick for the week and maybe for the year. I haven't decided yet, but I'll let you know. Hey, have a great week. Thanks for tuning in. I'm Jaden Sterling. I'll see you next week.